About 3 years ago, we co-sponsored, along with the Carbon Trust, a report done by our friends at Mercer on what the impact of climate change could be on strategic asset allocation for institutional investors. The report sort of came out and said basically that delay in addressing climate change could mean trillions of dollars of losses in portfolio, and increase portfolio risk by 10%. It went on to say things like, under sort of a standard scenario, if a portfolio is looking at 7% return, a 40% allocation in climate-sensitive assets of all kinds, infrastructure, clean energy, agroforestry, could actually reduce the risk, even though on its own it would seem that it would make it more riskier. But if you invested in the right type of assets that could adapt to a low-carbon environment, it would actually reduce risk. So we thought this was great. We publicized it. We talked to everybody. We thought this was done. Fast forward 3 years later, here we are. And we are still trying to figure out how is it that we are going to help and mobilize and unlock this holy grail of institutional investor money in a way that allows the institutional investors to meet what they need to do and their fiduciary responsibilities and the asset managers that they work with, while also unlocking the flows for both sort of low carbon development, if you will. Many recent reports, including by the Climate Policy Institute, have talked about what is it that, and OECD has done a lot of work around institutional investor. And so the themes that keep coming back are fix the policy barriers, try and create the relevant environment of, in terms of, if you will, allowing institutional investors to consider investment in these through pooled investment vehicles, and as well as appropriately risk-managed instruments. The only success so far we have had actually is in being able to attract institutional investors in the green bond space. And IFC, like many of the other multilaterals, has issued it. And our last issue was oversubscribed. But it was a AAA rated bond, which, honestly speaking, is great that it's being adopted as it is. But at the end of the day, it really doesn't unlock the kind of flows that we need to unlock, which would more be in terms of how do we bring institutional investors and make them comfortable with the asset-backed type of vehicles. How do we help manage the risk? How do we help meet the risk-reward profiles or risk return and the risk and yield profiles that institutional investors need? And all this amidst the policy uncertainty as well as the risk of going into emerging markets. So it's not, I guess it's, the magnitude of the challenge is huge. I am still hoping that the holy grail of institutional investor money is not like the true holy grail, which both ephemeral and impossible to find. So we're still going to keep at it. I will defer a sort of talk about pooled vehicles and the kind of things we're trying to do on the equity debt front for later in the discussion. But the point I really wanted to sort of make here in the context of our engagement on G2A2 with institutional investors such as my friend Manuel from Zurich, who's here, on behalf of the colleagues in other bilateral and multilateral institutions, is that we continue to believe that this can be done. We need a partnership that allows us to convene as well as bring to the table whatever it is that we can do. And I think between the spectrum and the alphabet soup of multilaterals, there's a lot that can be done in terms of trying to address risk. Not every risk that we want, that the institutional investors and pension funds want addressed, will be addressed, but I think a lot can be done. But it requires a very practical dialogue that extends beyond the whole issue around requiring certainty and expectation of market mechanisms or whatever. The opportunities are there. As IFC ourselves, we are investing close to $2 billion a year across the space. More than $1 billion a year is in real estate, in real assets, but it's not going to be enough. Some of you were at the session that IFC sponsored a little while ago, where we are looking at smaller deals, whether they are SMEs and the inclusive green growth, which we ourselves cannot do, but we aggregate effectively through intermediaries like domestic banks. So there are these platforms that we can actually try and bring together in a way that allows us to leverage our experience, our own risk management instruments, as well as perhaps capital from donors where we can't fill the risk, in a way that could, alongside us, give the comfort to institutional investors to perhaps start to wade into what I assure you are not shark-infested waters.
Vikram, let me come back to you and just ask you, put yourself in the shoes of these investors in the room. Where do you see the greatest opportunity for them to partner with IFC or other public finance agencies to find good and attractive investments?
I think as IFC, we've been investing for 50 years in emerging markets. We have reasonably good track record, I'd say. We've sort of had one of the few AAA rated institutions. It's not to say that our projects are all AAA rated, which would make it very easy to bring the institutional investors in. So we have had to get creative with how are we going to do this. So we looked at a couple of things. We said, what is it that we can do to try and bring institutional investors in to co-invest alongside us? So I'll give you a couple of quick examples. One's on the equity side. IFC has a track record, about 125 private equity funds, $2 billion invested in it. The climate change component of it is more recent, but overall the platform sort of exceeded all its benchmarks, in spite of being emerging markets benchmark, in spite of being more geographically diversified. So building on that platform, and although only about $350 million is invested in climate funds, we partnered with the UK government to effectively launch something we are calling the Catalyst Fund. And here's the irony, and I can say it in this room. It was originally called the Climate Catalyst Fund, but the word climate was dropped because it was considered toxic to institutional investors. So, I mean, I'll let that comment be. So the advice given on placement was, don't go there. So that's a challenge and a problem right there. But getting back to theme, the Catalyst Fund basically is a fund of funds, which will co-invest with IFC in all the funds that IFC invests in. And that's the whole idea, is to leverage IFC's experience, IFC's track record, and hopefully give the comfort to institutional investors and other investors, sovereign wealth funds and governments who are coming alongside, to take advantage of the fact that there is essentially an asset manager, and it's being managed by an IFC subsidiary, not so creatively called the Asset Management Company, which will actually be the fund manager and essentially leverage IFC's own due diligence in terms of trying to do that. So that's on the equity side. We started looking at the debt side. There's a lot of need, as Manuel's referred to and others have said about, especially in infrastructure. And we are beginning to explore with partners like Zurich and others to see how is it that we can create a pool vehicle to mobilize debt from institutional investors. And the way we are thinking about going about it is that if, once again, we took our own platform of investments and we, like I said earlier, we're investing about $2 billion a year with a target of going to $3 billion in the next couple of years. It's not, it's still a drop in the ocean of what the kind of monies we need. But if we could take that platform and alongside us provide a sufficiently risk-mitigated opportunity for investors to take advantage of the fact that there was a established due diligence process that had a respected environment, social governance approach that had delivered financial sort of performance and results over time, and is screening specifically for the sort of climate-sensitive assets that are maybe of interest to a lot of investors, and somehow find a structure where we can effectively, perhaps, we're thinking maybe $1 billion fund, which subordinates IFC to a senior tranche of institutional investors, gives them even more comfort. IFC is in it, and perhaps another bilateral or multilateral alongside us. And of course, the interesting bit in all of this is that it's still not going to be sufficient to meet the yield requirements of, even with all these sort of enhancements, we are finding that it's not going to be sufficient to meet the yield requirements of the risk that's associated with it. So you can tap donor funding, and it becomes an opportunity to demonstrate to the bigger public vehicles like the Green Climate Fund that are coming up, as to how can you use little pots of bits of money, and in this case, perhaps 10% of the fund has a sort of tranche of donor money that goes to effectively improve the yield of the institutional investors. And with IFC and the other bilateral, multilaterals in a mezzanine position, that sort of keeps us neutral to the risk we would have taken with the portfolio anyway. So those are the kind of things that we are trying to do. There are variants to this structure that would see commercial banks perhaps come in the early tranche, because in the wake of Basel III, clearly they're deleveraging, they're getting out of the long-term business, and the institutional investors want to be in the long-term business, but de-risking the early part of infrastructure investing by bringing co-investing, IFC co-investing with commercial banks, and perhaps in a 3 to 4 year time frame, turning that over, and with lower risk and of course lower yield, swapping it out for perhaps a 15-year tenor to long-term financing for institutional investors, and that may be the start of trying to issue asset-backed green bonds that allow us to start to fit into the kind of more standardized products and asset classes that institutional investors are used to. So